has been outspoken on. David Dodge is the former Bank of Canada governor, and he joins us now. David, good morning. Thanks very much for your time.
Good morning.
All right, you've had a couple days here now to process all of the details from the budget. What's your overall takeaway?
Well, first, it, along with the provincial budgets, is really not very helpful to the Bank of Canada in terms of dealing with inflation. So that's unfortunate. The big problem is that most of what the minister did was to concentrate on raising current consumption rather than promoting investment in machinery, equipment, and intellectual property, which is really necessary in order to provide workers with the capital that will allow them to be more productive. And that has been a problem now in Canada for a number of years. And this budget continued to emphasize that particular problem. And I guess the last 2 points I would make is I think it was very unfortunate, the capital gains measure, from the point of view of investment in risky new investment in Canada. It simply makes Canada less attractive place for that investment to take place. Certainly less attractive for small startups in this country. Remembering that startups really rely on paying their people with shares, and the capital gains tax simply makes that less attractive. Again, then the final point I would make, which I think is really unfortunate, the government said that they were going to try to boost the optimism of 20 and 30-year-olds and their ability to participate in the economy. But in fact, by simply raising the amount of debt outstanding, and I would note that the government of Canada now is going to be borrowing almost $100 billion next year to fund both the online deficit and the off-budget items. It's these young voters that are going to be saddled with the debt going forward. And so in a budget that was supposed to be aimed at helping that particular group, in fact, we have a budget which is very unhelpful for them over the medium term.
Which is definitely a different message than what we were getting from the federal government. So, I mean, at the end of the day, what kind of picture does it paint for the economy longer term, in your opinion?
Unfortunate, and this is at the end of a number of years of budgets that have focused on distribution and focused on increasing current consumption to cope with the cost of living, but failing to recognize that cost of living problem comes from the fact that our productivity has been stagnant or falling over that whole period since 2015. It's certainly stagnant in real terms, absolutely falling relative to all of our peers. And Canada simply looks like a less attractive place to invest now in 2024 than it did in the middle of the last decade. And I think that is the unfortunate thing, because it's only through investment in innovative investment that, in fact, we're going to raise our standards of living in the future. So this is I would say, unhelpful. I wouldn't say totally surprising, but unhelpful in paving a way for a brighter future for the Canadian economy looking 5 and 10 years down the road.
Speaking of the subject of investing in Canada, one of the other developments, as you know, another former Bank of Canada governor, Stephen Poloz, is going to be providing some perspective on this big subject where there is this curiosity around seeing our own pension funds invest more in Canadian business. We saw a whole host of CEOs sign a letter, and some in the investment community have called for this. Largely speaking, from the pension fund community, their reaction has been negative to it. They feel that at the end of the day, since their stakeholders are Canadians and they're looking around the world for the best returns, that they don't want government getting involved on that. In terms of getting more investment in Canada, how do you feel about this as one of the possibilities?
Look, the job of a pension fund is to raise money to pay pensioners. I'm a pensioner, so I'm on the side of the pension funds, and the pension funds are going to invest where they can get a reasonable return. It's not that they are anti-Canada in terms of their investment. It's the types of investment that they make with long-run investments, with a focus on infrastructure and infrastructure-like investments. We in Canada do not provide the funds the opportunity to make those investments here. We do not have toll roads so that pension funds can invest in road infrastructure. We do not have privatized airports or privatized ports so that pension funds can invest in those things. And so it's not surprising that our pension funds have to go abroad to make those sorts of investments. So that's number one. It's a failure not of pension funds or pension legislation. It's a failure of our inability and unwillingness, governments, federal and provincial, unwillingness to provide those opportunities. And so if indeed, if firms in Canada can deliver a profit outlook that looks as reasonable and good as the profit outlook abroad, then pension funds will invest in Canada. The fact that they haven't is a failure to produce the sorts of returns on Canadian investment that they can get in foreign investments.
All right, a lot